So I want to start out with just some introductions. Can you tell us a little bit about yourselves and specifically what got you down the crypto rabbit hole? And Chris, why don't you start?
Yeah, so I help manage money for UNC Management Company. We manage the endowments for the UNC system. In aggregate, we manage about $6.5 billion. What first got me involved into the space probably goes back to 2012, 2013, when I was talking with some of our VCs about where they were investing their personal capital, and they all mentioned Bitcoin. So that's what kind of got me involved personally. And then institutionally, we've seen kind of a little bit of evolution where we've seen some of our VCs kind of have generalist exposure, and now we've seen dedicated funds in the space.
So I started my career as a trader in 2004, then moved to an asset manager that allocates to alternative investment funds for institutions. And my last job before this one was working for a family office, and thankfully for a family office, an owner that was the previous owner of that asset manager, so a sophisticated client. And I found that the easiest way to manage capital was to run an unconstrained mandate. So we were involved in distressed, and we started getting involved in fintech because obviously it made a lot of sense. We co-invested in European fintech deals such as TransferWise and N26, so all very successful companies. But then when started learning about crypto on the back of that unconstrained approach in 2015, realized that our current investments that are very successful were running that platform risk that Kyle just talked about in terms of that S-curve. With respect to at the end of the S-curve, once those companies are very successful and need to IPO, those very low rates and fees and advantages that we have today could potentially change. And this is where crypto made a lot of sense, and it's the natural evolution. It was the natural evolution for us as a family office. And we saw that the opportunity was so large and decided to use our past experience to launch a new firm fully dedicated in fully focused on the crypto space.
Thanks. And so, one of the most common questions that we get from allocators is around trade-offs between, investing with managers or investing directly. And I'd love for you both to, talk a little bit about those trade-offs, because I think both are valid approaches, right? But each comes with a cost, and so, what do you think?
Do you want to start, or do you want me to start? So I think on the direct side, it's been really challenging as an institution to invest until extremely recently. So one of the big challenges is we would need a qualified custodian to custody the assets, and those didn't exist until about a year ago. So that really limited our ability to invest in the space, right? We simply didn't want to manage private keys. There's some inherent risk there. So that has evolved to today, and I think it makes sense to have some direct exposure because I don't need to pay, no offense to managers out here, 2 and 20 to invest in the Bitcoin. But then on the fund side, I think we've seen an evolution in the space. I think we're going to see something similar to what happened in the late 90s, where historically you had generalist VCs who invested in both biotech and IT. And as those markets evolved, you saw kind of a bifurcation, and you saw verticalized funds invest. So it essentially became just IT and just biotech. What we've seen in the space over the past several years is you've seen some VCs who have been generalists. There might be one crypto specialist. Recently, we've seen those individuals spin off. And so I expect that will continue, and you'll see kind of crypto native funds continue to take over the market.
So generally, I would say that, and that experience applies to traditional markets as well. So passive versus active, essentially. So whenever you have a market that is super efficient, let's say a manager that you want an expression of have an exposure to US equities, large caps. In our view, you have to go passive. While if you want to invest in Argentina or Russia, it makes sense to go active. And I believe that the same applies to crypto. So on the passive side, the benefit is that you've got liquidity, and as a family office, you can deal with the custody issue. While there's massive asymmetry of information, of knowledge that some of the managers possess, and the gap between us and the manager is huge. And I think that an active approach within the space, because of those inefficiencies and that asymmetry of information and knowledge, can yield a lot of returns longer term.
And there are actually additional challenges by going direct that we haven't touched on. Kind of another thing to think about is if there's a hard fork, are we in a position to determine which direction we want to see and how we want to participate? And so that's one of the benefits of having a manager serving as an intermediary to provide that guidance to us.
And so I want to dig a little bit deeper here, right? And talk about the knowledge gap and, just think a little bit more about managers generally in this space. And I'm curious, what do you think are the fundamental sources of manager edge? How can managers have edge? How can they express that edge? And then, maybe we can talk a little bit about how you as allocators can determine, what edge makes sense for a particular asset class, and how do you determine which managers fit that? And why don't we start with you, Ray, this time?
Yeah, so it really depends on the strategy, the sub-strategy. So the way we look at the space in terms of sub-strategies as well. So from one extreme to another, we've got the VC-like funds to the trading funds, so the market makers, let's say. And there's obviously you need very different talents across sub-strategies. So if we talk about, if we refer to a fundamental manager or a manager that has a venture philosophy, obviously sourcing is one of the major edges that is needed. And that can come from their brand, from what added value they have towards the projects, which is very important. Their technical expertise is important, their understanding of tokenomics. And at the end, you need to have a minimum of a risk management skill set that comes from traditional finance. So it's multidisciplinary in that respect. It's pretty difficult to find. And of course, not every team is covering all bases. But essentially, that's what we look at across the board.
Yeah, so once again, it does depend on the particular type of asset you're looking at. So if we start just on the venture side, my view is very, very simple. At the end of the day, I want to partner with the group who in a head-to-head battle with everybody else is going to win. So what is going to cause them to win the deal over somebody else? Like, we can talk through that. There's tons of different ways you can do it. It could be helping from a legal or regulatory standpoint, could be helping from a talent recruitment standpoint, financing longer term of these projects and businesses. So there's tons of different ways, but at the end of the day, it comes down to talking to the entrepreneurs and seeing what they value and listening to them as to why they would partner with somebody over somebody else. On the kind of the liquid token side, so there's tons of different ways you can do it. I think part of it is, like, we're going to listen to it a little bit later, the data science aspect. And so if you have knowledge around existing wallets and you're able to kind of track flows before the broader market recognizes that, that gives you a potential edge. I think, once again, on the legal and regulatory side, there's always a huge opportunity there as well. So it just depends.
Yeah, and I want to dig a little bit deeper here because I think a lot of the heuristics from venture investing do carry over, right? These are early stage technology investments. And so a lot of that skill set is very relevant here. But also, I think there's this element of public markets that is just, it's very unique to crypto to have early stage technology investing plus public markets. And I think that's not going to go away. We're not going to evolve out of it as an industry just because of how the technology works, right? If you had to stake Uber shares in order to drive Uber, Uber would be public already. Uber would have gone public 10 years ago, basically, right? And so how do you think about like a multidisciplinary edge, like you were saying, Ray, right? Like, how do you think about managers building that edge? And then how do you actually evaluate if they have it? What kind of questions do you like to ask? And what do you want to hear in that type of conversation?
So So it really depends on what we're trying to achieve as well. So, let's take an example. So your point is very valid with respect to mark-to-market is very difficult to, so essentially it's easier if there was no mark-to-market, right?
Absolutely.
Yeah. So because that's potentially very distracting. You're going to have your investors following up with you whenever you have, large drawdowns. Essentially, it's, if we're looking at a long-short manager, which is scarce in the space, that works to your benefit, I guess. So, so there, what do I get as an investor? I'm looking for idiosyncratic exposure, which is scarce. So I'm substituting market risk towards idiosyncratic risk. What is super important when you run a long-short strategy is this is where risk management comes into play, right? So I need to understand from a risk framework what are the concentration limits. I understand that it's going to be concentrated, and that's what I'm seeking essentially. But what are the concentration limits? The risk limits on the short side. Their borrower infrastructure. How advanced is it? How integrated are they with their counterparts? This is obviously very, very important. And finally, so it's a little bit difficult to mix everything together, but all I want to say is that every sub-strategy has a due diligence format that is completely different, which makes it much harder, and that's where the multidisciplinary angle comes into play. Now, of course, there's a lot of data out there to the process of triangulation within that small market enables us to confirm that potential edge is there. You'll never know for sure, but that's how we approach it.
Yeah, so to echo that point, we want to avoid blow-up risk, right? This is an asset class where you should expect you're going to be down 80% over some period of time. So part of it from the GP standpoint is making sure you have capital from limited partners who are in it for the long haul, making sure you structure your funds appropriately so that when you have that massive drawdown, you don't get redemptions. So I think there's a huge component there. On the short side, there's additional risk, right? Where are you keeping your collateral? How do we think about the exchange risk and whether or not they can be hacked? So there's additional layers of complexity that we don't find in traditional equity markets where it's a slightly more evolved and mature space.
Mm-hmm. So I want to think a little bit about being inside the mind of an institutional investor and being the crypto champion at an institution that maybe isn't full of a bunch of people who are enthusiastic about this technology. Lots of references to tulips, I'm guessing, right? And so when you combine that with something like mark-to-market and extreme volatility, how do you balance that within the organization? And what kinds of challenges does that uniquely present?
Yeah, so I guess we'll talk through kind of the first wave of institutional capital that has come into the space. So I think you're all aware of some of the big brand name firms that raised capital last year. And I'll give you my input on why they were so successful in raising capital. And no offense, at the end of the day, I'm not sure it's a very strong belief in kind of crypto assets broadly. I think what it came down to is the pitch that you can make to your organization and to your board, right? So let's talk about a couple groups, right? At the end of the day, you're betting on individuals who have been extremely successful in their previous careers, who have potentially made a lot of money for those investors, who are now, essentially betting their entire professional careers on this. And so the way, we would think about it and others would think about it is, hey, somebody who we really respect, who is a great investor, is now dedicating themselves fully to this. So clearly they see an opportunity. Shouldn't we participate in that to an extent? And so I think you've seen that trend continue. You've seen some of those raise fair amounts of capital. But we haven't yet gotten to the wave where a lot of institutions are making that bet on, hey, we think this is going to be a long-term asset class. It's going to deserve its own asset class and asset allocation. So we're still early on in that movement.
I mean, I could cover it from a family office perspective. So let's, an entrepreneurial family office, so an aggressive family office. So let's say an entrepreneurial family office. The way they should look at the space, and that's how we looked at it under our family office at the time, was that whenever you have an asset class or a strategy that provides tremendous asymmetry, you can actually risk manage it. And you can risk manage it through sizing. And I would even go to an extent where, and in addition to that, because at the end of the day, the only free lunch is diversification, but diversification is very, very difficult to achieve. You need to, I think those type of strategies combined with asymmetry can help out from a portfolio perspective in the long run. I would even say that from a long-term risk management perspective, not being invested is an actual risk. So you're, as an entrepreneurial family office, you're kind of forced to be invested.
Mm-hmm. Yeah, so to that point, I agree completely, right? The way I think about it is we don't actually expect everything we invest in to succeed. Because if it does, we're ultimately not taking enough risk. So to that point, we want to make sure we build a diversified portfolio that in the long run should include assets that would hopefully overcome anything that we lost money on. So there's a component of that. And then it comes down to, like, what was the original argument? And it was a very simplistic argument, right? So back then when it was just Bitcoin, in talking to people, like legitimately the best argument I heard was you put 1% of your net worth in it. If it works, it becomes 99%. If it doesn't, you lost 1%, right? So that speaks to the asymmetric upside. And we've seen kind of that market continue to evolve. And from a portfolio standpoint, it's fantastic to have something that's uncorrelated with broader equity and fixed income markets that has a true kind of asymmetric return opportunity.
So I want to talk a little bit about crypto-native funds and crypto-native edge versus more passive or other strategies that are also investing in this space, right? And a lot of the traditional venture managers, like you mentioned earlier, are starting to dip their toes in the water. They're interested. Do you think that traditional managers or managers that are not solely focused on this space can execute properly in this space, or do you think that specialized managers make more sense? And either of you, whoever wants to go first.
So I would say that so if you need to have a full-time team that's allocated to the space. I mean, even from our side as allocators, I had to give up my old job to spend 100% of my time to that space because it's very deep. It's very fast. It's a completely different world. So I'm favoring crypto native funds and firms for that reason. Because I feel, and I might be mistaken, but I feel that the edge that they have, there's still a gap between them and the venture funds. And for that reason, I think there's a reason why several of those venture funds are investing in crypto-native funds, because it makes sense in that regard. So that's my
So I think generalists can be successful, and they will continue to be successful. But I do think you're going to see a continued trend towards crypto-native funds because it is an extremely kind of difficult sector to kind of have a broad knowledge base, given how quickly things are evolving and developing. It's also hard to stay on top of this unless it's your full-time job. But there are always kind of rare people who are just amazing, who can invest across all asset classes, all geographies, and be successful. the one dynamic we haven't talked about, and it's something I referenced earlier, where we saw a split between kind of IT funds, generalist funds who had IT and biotech. There's always internal dynamics in politics. And so when you have a team who's focused on one sector, who's really crushing it and succeeding it, and they're splitting economics with another team who is maybe doing less well, there's always the challenges of, hey, you're diluting my economics. And so I think you'll continue to see that where people want to raise kind of a specialized fund where they're ultimately betting on their success and the success of their sector rather than kind of the broader team and the broader view of that. So I think you'll continue to see kind of that trend. I think eventually this will become a very capacity-constrained market. And so back to talking with entrepreneurs and thinking about the types of people they want to work with, I think the pitch of, hey, this is the only thing I do, I'm fully dedicated to this space, relative to a generalist who kind of dips their toe in the water, it's a much easier pitch to make to that entrepreneur to take your money.
Mm-hmm. Yeah, absolutely. And looking at this from the allocator perspective, right? There's a huge advantage that generalist firms have, which is they have track record, they have history, right? And that's one of the easiest things that an allocator can look at and understand without necessarily needing to understand the nuts and bolts of the technology, right? Because let's say you're a 2 or a 3 on the knowledge scale on a 1 to 10. How do you tell the difference between someone who's a 7 or someone who's a 9, right? It's very difficult to do, right? And so how do you've both allocated to the space, right? And you've gone fairly deep, but do you think that allocators who are interested in investing in crypto native funds, perhaps funds that don't have 10 years of history just because this whole industry is not that old, it's actually impossible, do they need to get that deep into understanding the technology in order to be able to vet which managers actually understand it? Or are there other heuristics or tactics that they can use to evaluate manager knowledge without necessarily having to build up that entire knowledge base themselves, which is very time intensive and it's a lot of work to do?
So I think it's possible to develop that skill set. And so part of it is leveraging your network, right? Just ultimately, are there other people who are well-versed, who have insights, who have great connections, who can give you insights that essentially allows you to leverage your time? I think that's a possible way to do it. But ideally, it's somebody who's well-versed, who understands the technology, who has a great network and is well-versed in the ecosystem. You want to expand?
Yeah, I mean, I would say that a track record is used for, when you approach a committee with a track record, it's easier to sell, right? It's good for marketing. Yeah. But to be fair, and that applies to, liquid strategies as well. I mean, we've been investing across hedge funds and managed strategies for a long time. And, good track records, yeah, they're not successful investments at the end. So because it's actually very difficult to analyze a fund with a great track record, because what you need to do is that you need to predict sustainability. And that's not easy to do. So we've been trained to approach every fund by looking at the quality of the team. And the track record is used for confirmation, essentially. And so I think that, funds, crypto native funds that have a year and a half of track already give you quite a bit of information as confirmation. But I would say that, the way we approach it is similar to the way we approach, a fintech startup. It's all based on the quality of the team, the processes, their edge. And I think it applies to crypto native managers as well.
Yeah, so actually across our portfolio, we don't really invest in strategies, right? Things can change, opportunities can change. We're ultimately betting on people because they're the ones who have the capital, who honestly, have the ability to steal it and defraud us if they wanted to. But more importantly, if they see the opportunity shift, right, they can pivot the organization, they could pivot their investment strategy with the goal of kind of optimizing returns.
Yeah, and just staying on this point of track record and pivoting strategies and evaluating managers.
Sorry, one other question, or at least one other answer on the track record. What I'll actually say is, because this is such a nascent industry and there's so little kind of institutional capital in the market, everybody in the industry wants to make sure that we're successful, right? Because ultimately, if we have a good experience, we're going to tell our best friends about this, and that's going to continue to drive institutional adoption and capital. And that capital is ultimately what's going to help determine the winner, like the broad winner in the space. And so everybody in the industry is amazing. They will tell us, who's good, who's less good, things we could focus on and dig in. And so the industry is helping us conduct diligence and making sure that we're ultimately going to be successful.
So talking to other managers to see what they think about...
Not just managers, right? Just people who are relevant within the industry.
Yeah, that's a great point. It is a small world and a small industry for sure. And so how do you look for, how do you identify false positives from your diligence process? Or how do you try to eliminate false positives from the diligence process? Because, one of the risks in this industry with new managers that are showing up for the first time, with a new asset class that's difficult to understand, is if you're looking at historical performance, how do you tell the difference between, luck, like made one great trade, was long Bitcoin in 2017, it was great, that's the entire track record, and telling the difference between that or a firm that has built, a repeatable, sustainable process to actually earn strong returns. And I think that can be a difficult differentiation to make. So what are some of the heuristics or questions that you like to ask yourself or the manager in order to help make that determination?
Yeah, so we like to see every investment they've made to make sure that it isn't being driven by a single investment decision. But look, I'll actually punt the question to a certain extent because I think we are long-term permanent capital, and we don't have to rush into the asset class and make that investment in, maybe the one genius who made that great trade, and hopefully, maybe they become kind of the best investor over the next decade, because there will continue to be opportunities to kind of gain access and invest. And so we can slightly delay that decision until we have a broader history. But if, they've only been active in the space for a year or two, what we would ultimately want to see is success in prior lives, right? So what other jobs had they had? Have they been successful in those businesses, in those functions? Because success breeds success.
Like I said before, I think a track record is there's a lot of weight that's put on a track record, and as I said before, at least for me, it's never worked. The best combination is, for us, has been a great team with great processes and a boring track record that is expected to start performing in a change of a market regime. So you do have to have a deep understanding of the strategy, and the way we've done it on the crypto side is that we've, the funds that we're invested in today, we've been talking to them for the last year and a half. So we're, and that involves multiple touch points, on average 10 touch points. And so we need to, and we're experienced in hedge funds and stuff, so we understand what kind of, we break down the types of risk that a manager is taking. Is it market risk? Is it idiosyncratic risk, basis risk, liquidity, etc.? Do they apply leverage? So it's not very difficult, if transparency allows, to understand to understand how capital is managed, and most importantly, there's a lot of data out there in terms of some of the measures that come out with research reports and apply it. So you can cover all of those things. Yeah. What kind of deals did they get involved in that prove if they have sourcing power or not? There's a lot of data out there.
And so part of it is, to put it simply, institutional investors look for reasons to say no, not reasons to say yes. Mm-hmm. And so if you see that their track record, once again, I don't know how relevant that is, but if there's a single trade that made them money, that would be a no for us, an immediate no.
Got it. And so, Ray, you just mentioned something that I think is really interesting, and I want to dive deeper into is, what are some of the things that you're looking for from the team in your evaluation process? What are some of the processes within the organization that you look for as a part of your due diligence? Because I think, organizations are a combination of people, processes, and priorities, right? Priorities for an investment manager, pretty easy to kind of figure out. And so, what are some of the people that you look for? What are some of the processes that you look for that you think can help you differentiate between managers that you want to back and managers that you don't?
So I would say that first of all, we're trying to target as a core strategy, and that doesn't apply for the entire portfolio. We want to provide a symmetry to our investors, which means that we need to capture that asymmetry from underlying managers, meaning that that active manager has to add value, and whether it's through selection or whether selection on the liquid side, whether it's selection on the illiquid side in deals that have acute asymmetries. Now, of course, transparency. So individual characters are very important. So. We look for managers that are fair, transparent. We look for segregation of duties across investments and operations, which is important, because at the end of the day, the industry is not very mature. So it's rare to find managers that are institutional enough for us to invest in them. So it's if you combine the blockchain and crypto angle, you need to combine it with that risk management mindset, or that, which is very rare, because one of the differences between this industry and others is that, if you want to invest in a hedge fund, he's probably traded or was a PM at another hedge fund or used to trade at Goldman, and so you can reference him very easily. There's a track record in that respect. While here, you have young teams that are starting from scratch. So that trading acumen or that risk management acumen, which is rare, is probably one of the key attributes that we're looking for these days.
So that's one of the key processes that you really want to see.
Yeah.
And then in terms of, you said separating out operational duties, so you're looking for like a robust back office.
Absolutely. And specifically segregated functions, right? Which doesn't really exist in this space. But there needs to be, specific processes. You need to show that it was well thought through, right? In terms of operations on the investment side, who covers what on the investment side and the operations. And so essentially that's why you need, despite the fact that AUMs are pretty low for those funds, you need a robust team behind it, so.
Yeah, so to an extent, you want to minimize key man risk. And I mentioned it earlier, right? We are investing in people, not necessarily strategies or even structures. And so we spend a lot of time understanding the dynamic amongst team members, because the most frequent cause of firms blowing up and going under has nothing to do with their investment strategy. It has to do with like interpersonal dynamics. And so we want to make sure that there's a history of the team working together, of going through challenging times, of them having common views, of them having relatively equal economics, and ultimately having the right long-term vision, right? We also don't want to be invested in groups who are in it for a quick buck, right? Do they want to do this for decades? Because we are permanent capital. We anticipate backing these things for multiple funds over a decade plus.
And the interesting dynamic that you have just related to Chris's point is that it's a very interesting dynamic right now, that AUMs, even across some good crypto native funds, are pretty low, which means that you can easily see how dedicated to the space they are, because most managers are not covering their costs through management fees, right? Essentially, they're seriously incentivized to really perform. Now, that means that some are taking undue risk, which you need to identify. I think you can identify it pretty easily. And others are actually thinking long term, and the only way for them to generate cash flow is through performance fee. So essentially, there's an alignment, which essentially could change later on, right? As the industry grows, and it's a utility function that we watch very, very carefully.
Yep. So actually, that brings up a really interesting question is, what do you think is the sweet spot in terms of fund size for this industry, given liquidity constraints and market infrastructure? You both have gone pretty deep in understanding this industry. I'm curious, what do you look for there? Is there a fund that's too big, or is there a fund that's too small that's just not worth your time? You don't want to enter there. Is there a sweet spot in the middle?
It really depends on the strategy. I mean, a trading strategy, cannot handle more than, 15, 20 million these days. So yeah, there's a challenge there. So the big challenge is, how does the team survive under such an AUM? Do they have the right structure maybe the business doesn't make sense at all, right? Mm-hmm. While on the fundamental side, something around, AUMs between 50 to 100 million. But I would say that the AUM question is not, it's not like we have a minimum of AUM that we need to have to invest in. It has to do with the vision of the team, how committed they are, because that AUM can grow, right? And if we can have access to a great team that can perform and grow that AUM, we're not going to miss out on that.
Yeah, so the only other point I'll add to that is it clearly does depend on the strategy. If I just want passive exposure and I want to invest in an index or a glorified index, right? That's obviously much more scalable than some of the more active investment opportunities.
Yeah, absolutely. And so let's talk a little bit about sizing, right? For institutional allocators, crypto is not going to be the only thing that they do, right? And recently there was a report that came out from Cambridge Associates, which I think is pretty widely circulated. We'll send out a link in the Telegram group for those of you who have not seen it yet. And they made some sizing recommendations in there, telling institutions to look at something like 50 to 100 bips. Can you guys react to that? What do you think? Is that the right size? Is it too much, too little? Is it too hard to tell? Really depends on the situation.
I think it's reasonable in today's environment. We're targeting kind of a 1% allocation in crypto dedicated funds over the next kind of year or so. We're probably about halfway there. And so I think it makes sense. It's like longer term. You need to see continued traction within the market. You need to see continued adoption and the continued evolution and hopefully creation of this as an asset class to justify kind of a much larger allocation. But we put all of this exposure within our venture capital portfolio, right? Even if it's a hedge fund, it goes into our venture capital portfolio because we think kind of the risk return of the opportunity set most closely resembles seed or early stage venture.
So it actually really depends it depends on the implementation of that crypto portfolio. So if you're going for long only and super volatile implementation, then of course 1% probably makes sense. But I would say that for an entrepreneurial family office, you can go up to, and what we were planning on doing is to go up to 5%. But we're implementing it with less risk, so less market risk, more idiosyncratic risk. So we're substituting market risk for other types of risk. And we're trying to mirror that hedge fund mindset rather than being long and absorbing all that market volatility. And then at that point, you can go to up to 5% for sure.
Got it. Okay. And one of the other really common questions that allocators ask us or are thinking about is around timing, right? And I think this is one that I'm really interested in hearing both of your views on, because I think it might differ a little bit from the permanent capital institution to family offices, more entrepreneurial family offices that maybe have a shorter term time horizon than a permanent institution like UNC. And so I'm curious how you think about trying to time, given the enormous volatility in this market. Obviously, if you made your entire investment in December of 2017, that would not have been the best idea. But December 2018 was a fantastic time, right? And so how do you think about that, especially given the constraints of lockup schedules and fund lives and when the manager is actually out there raising capital? It's a pretty complex set of calculations.
So since we focus mostly on the liquid side of things, I would say that there's reasons why I think it's a good idea to scale up your investments in crypto. First of all, and that's not financial, I think the dedicated person that covers that area needs to scale up because it's a dynamic space, and they need to still stay connected to the space. I mean, just to allocate once and forget it doesn't make sense. I mean, you need to continuously learn about the space and change your portfolio over time. And two, of course, about timing, and this is where, from a portfolio construction perspective, we started our vehicle November 1st of last year, which would have been great to start it December 1st, or February 1st, but anyway. And we started conservatively, very conservatively, so we had in mind how much market risk we wanted to run. So thankfully, we avoided most of that correction. And at the same time, and I know that it's very difficult to time those things, but initially, and this is why we scale in, and so we started scaling in February 1st, because we felt that running low market risk in January when everyone was so bearish became very dangerous. So we use those approaches that we've been using in traditional markets, where whenever you have very strong consensus, you want to de-risk when it's overhyped, and whenever you reach distressed territory, which is very difficult to assess in crypto, this is where you add more market risk, and that's how we manage it.
Yeah, so we are terrible market timers. So the way we think about it is we ultimately kind of have this dedicated allocation we want to the space. It depends on the strategy, right? So if it's a venture fund, we can't time when we invest. It ultimately comes down to when they raise, and we want to continue to back them across multiple funds and ultimately give us that broad exposure. On kind of the liquid public token side, we can be a little more dynamic in when we deploy capital, but at the end of the day, it's kind of like we're going to have this really long-term view. Maybe we're not going to hit the exact bottom, but as long as we continue to remain active, and when we see a massive drawdown, right, when we see an 80% drawdown, continue to fund additional capital into the space, we think overall we can create an attractive blended return over that time period.
That makes sense. And then the last question that I have for you, and we're going to open up to Q&A from the audience, is a bit more tactical, and it's around service providers and other infrastructure that you expect to see from managers. And you've both gone really deep and understood, probably you have an understanding of the service providers that are even available in the crypto industry, right? What do you look for? Who are some of the favorite service providers that you like, maybe, that you want to see involved in a manager that you are considering investing with? And what are the most important types of service providers? Is it the audit firm? Is it the legal firm? What are you most interested in on that topic?
I think personally, there's a bottleneck with administrators right now, and that I'd love to see other players come in to just release that bottleneck and get a better service generally from the industry. That's number one. Number two, it'd be great to have the prime brokerage approach that you see in the hedge fund space. So I don't know, someone similar to Goldman that approached hedge funds like Goldman did, and that would help everyone within the space with introductions to valuable investors, valuable funds, etc. But I think generally, so far the service providers are doing a good job. But there is, it could, I think you need more players to to get a better service out of the industry.
Yeah, so I won't name favorites in the service industry, but what I'll say is something that's been extremely important to us over the years is making sure that whoever we're partnered with or invested in is using a qualified custodian. There's a very limited subset of those out there. It'd be great if they could integrate with our custodian. That's something that hasn't kind of had widespread adoption yet, but it will come. I think on the audit side, there's been challenges in understanding exactly what this is, how you should value it, what exactly mark-to-market should be. We've continued to see pretty rapid kind of increase in knowledge in that space over the past couple of years, and as more institutional capital flows into the space, I expect that trend will just continue to increase.
Thank you. And so we'd like to open it up for questions from the audience.
Group here. Kareem asked a good question. How do you evaluate a crypto native manager that comes from a non-finance or non-capital allocator background that will have inevitably a limited track record in this new space?
So it really depends what strategy he's trying to apply. So if it's a trading strategy, obviously it's probably a no-go. Essentially, trading strategies are being covered by talent is coming from, let's call them Wall Street and systematic managers, which makes a lot of sense. Whatever, on the fundamental side, you have a much more of a need of that venture philosophy. So, whenever they're investing in actual project, analyzing the tech is important. Analyzing network effect is a business viable, and then this is where a venture background might make sense, a computer science background might make sense, but there's no one answer. Again, we're back to that multidisciplinary skill set. So you need several of those members that cover those, and finally, hopefully, you'll get that risk management skill set that they will have to learn on the job.
Yeah, so the only thing I'll add to that is what I touched on earlier, which is we're investing in people. And so hopefully there's people in the ecosystem who think highly of this individual, who can speak to their kind of knowledge, ability to be successful. And outside of that, it's going to be a pretty big challenge for us to get comfortable to invest.
We had another question from the chat room from Greg. And Chris, you kind of touched on this on your answer previously. How do you, as allocators, manage market risk around custody? Is commingling of assets for liquid funds acceptable?
So I think the answer is yes. And so actually something I would think about that is important in a custodial solution is their ability to offer their clients insurance. I think that's something we haven't seen broadly throughout the market, but that would really get us comfortable, particularly with commingling.
How do you feel about your equity long-short managers or long-only managers starting to take crypto exposure, whether it's just straight, I don't want to say GBTC, but something similar to that, or taking explicit theses within other equities tied to crypto?
Redeem.
You?
Yeah.
You like it, you said? Or?
No, he said redeem.
Redeem, okay. So I mean, these are even managers that have, big positions in the top tech names today that might see disruption coming from the decentralized world. You don't want to see any commingling between those?
I mean, I don't think they have the skill set to do so. And it's a skill set that is very particular, and that's one of the reasons why we're taking the risk of backing managers without a track record, because of that skill set. And I mean, that's classic, change in strategy, and no. Now, sorry, just to say one thing. If options market in Bitcoin and crypto start developing and it becomes a a right macro play, you might see macro players come in and express, I don't know, a fiat debasement and expressing it through an option structure. If there is asymmetry and it's structured the right way, maybe. But long-short equity, no.
Yeah, it ultimately depends on what exactly their goal is, and if it's an arb trade, and that's kind of what we were invested in with the expectation that they were going to ultimately invest across arbitrage strategies. Sure, but if it was just like a traditional long-only token or long-short that is more fundamentally driven, it'd be hard for us to get comfortable with that as well.
How do you, given the kind of global nature of the space, and I'm an allocator to hedge funds, so that's kind of the world that I come from. How do you ensure sort of comprehensive sourcing of the manager universe, given how, at least in hedge fund land, you have prime brokers, you can go to them, and there's definitely plenty of people, trying to hawk their wares, but there's a lot of rocks that you got to turn over in this world.
So once again, it always comes back to people and network. And so hopefully we are connected to relevant industry participants who think highly of that group, think highly of that person, and make the warm intro, and ultimately help us diligence, right? But there's a few additional challenges. Depends on the country, depends on kind of language barriers, cultural barriers, like currency barriers, right? It simply increases the bar for us to invest.
So the way we do it is, so there's a few channels of sourcing. So there's our hedge fund network that takes care of the traders, our VC network, and our crypto network that we've developed since 2015. But because it's a small space and people actually matter, and the best way to due diligence is through a triangulation approach. We're on the road practically all the time. So if there is an interesting conference, we're in Asia, we're going to it, and I'll most likely meet Kyle there again, and or TUSHAR, and I'll have multiple touch points. So we see our managers, I don't know, I guess physically maybe 6-7 times a year, which is much more than in hedge fund land. And there's a lot of referencing, which is the main, as Chris said, the main part of sourcing. Versus on the hedge fund part, going through the list of hedge funds, looking at their track records, we don't do that in the space.
But it's a very, very valid point because this is a global phenomenon, right? It isn't going to be concentrated in the US. And so it is important for us to broaden the network to make sure we have relationships with people across the world to help source the best opportunities.
Question for... Thanks again for your time. This is Dan Zeller with Mission Hill Advisors. My question for you is, even though we are in the extremely early days of having tokenized funds, in other words, tokenized representations of LP stakes in other funds, how do you envision that growing in the future? Would that be, in other words, what are the advantages and disadvantages for capital allocators like yourselves? And how would you diligence that?
Yeah. So essentially tokenizing a fund, right? Yeah. The first PPM that I looked at that's related to that offering was, a year and a half ago. And it was horrific, non-investable. And in addition, it's very nice to tokenize a fund, but then, I haven't thought much about it, but my view is that you'll end up with, you've got those listed funds in the London Stock Exchange. They're always trading at a discount, right? So you need liquidity for those funds. And you can never get out of them unless there's a liquidity provider. So there's a risk of being trapped in a fund where, yes, it's liquid theoretically, but it's liquid at a pretty large discount.
It's understanding why they're doing it. Like, what is the actual reason that they want to tokenize this vehicle, this asset? And is it just a gimmick, right? Is it just a marketing gimmick to help them raise capital? So we'll spend time focusing on that.
A question for Chris. What do you think the large institutions like pension funds and endowments are waiting to see in the market, and what's the tipping point before they come into the market in size, and how far away are we from that?
That's easy. Adoption, right? Like just mass adoption of whatever the particular project or service is, because we haven't seen very much of that over the past several years. You know, when exactly I think that occurs, I have no idea. If I did, like, I'd be trading and hopefully be a billionaire in a few years. So I think from our standpoint, the way we would think about it is it comes down to portfolio construction and making sure that we have bets across multiple different types of assets, whether it's venture, whether it's long-only token, long-short token, potentially like direct exposure to public tokens, potentially direct exposure to infrastructure companies in the space. Because we might have an educated view on what's going to be successful, but anybody who sits here and says, you know, store value is going to win out, it's going to be Web 3.0, they're lying to you. So it's important for us to have some exposure to kind of that broad subset of opportunities. But the thing that would drive, in my opinion, that would drive institutional capital is just seeing actual adoption.
So question, we talked about this yesterday a little bit, but not for algo trading fund, but for a VC type of fund investing into pre-sale, and then maybe some traded coins already, you know, equity or equity plus tokens. What is your preferred structure? Is it the hedge fund structure? Is it a typical VC type of structure, 10 plus 1 plus 1? And then second part of the question, what is your preferred way to obtain liquidity, quarterly basis, you know, at exit?
I mean, it depends on the underlying investment. So I guess there's a big difference between an equity investment, which should be under a venture format, so 10-year, while token, yeah, it is debatable. And of course, I'm conflicted, but I'd rather have it under hedge fund structure with the maybe with side pockets, a series of side pockets per investment. And yeah, essentially get liquidity at realization.
So kind of on that point, even if it is a hedge fund structure, we're actually okay with a longer lockup because I actually think that keeps some institutional capital away. It keeps some kind of fast money away because the risk is, look, you should all expect an 80% retrenchment, right? It has occurred time after time. And so if you don't have the right LP construction, if you don't have the right like asset liability match, you run the risk of whenever you see that retrenchment in performance of getting massive redemptions. And then, no offense, you're going to go out of business. And so the best time to invest is when you can't raise capital and ultimately we'll have to turn over the keys. So I think we're okay with having a longer lockup, given that we also are permanent capital, can kind of take the illiquidity risk.
I think we have time for one more question.
Yes, I have a question. So I think if you asked everyone in this room how they got interested in crypto, you probably wouldn't get the same answer twice. And I think that what resonates with one person may not with another. So I'm curious, as you guys have had your internal conversations, sort of what themes and theses around crypto and managers specifically have resonated the most in getting, you know, investment committee members over the hump?
So I think for us, it's like the story as a digital gold, right? We've seen kind of more traction in that market than we have in the Web 3.0 market. And so I think it's easier to make that argument today. And so we've seen kind of a preference from some of our investment team members and our board members to buy into that view. But once again, who knows?
I mean, apart from the fundamental attraction and the potential of the technology, a secondary reason why we're involved is we're always looking for that, where does active management strive? And where we are always avoiding competition, looking for strategies that are fundamentally sound, where there's no competition, and this is one of them. And so if I purely wear my investment hat, the potential of the technology, but most importantly, the fact that it's a field that enables a good team to perform and outperform consistently, at least for some time.
And kind of the additional component is, at the end of the day, you have to believe that the world will look different in the future than it does today, right? If you think things aren't going to change, this makes no sense. And so I think we have seen that over the past several decades, well, I mean, even generations. And so there's that fundamental view that, once again, things will change.
Awesome. Well, thank you very much for joining us today, and thank you, everyone, for your questions.